Something extraordinary is happening in the silver market right now, something that hasn't occurred in over 4 decades. And if you're not paying attention, you're about to miss one of the most significant wealth transfer opportunities of our generation. Let me paint you a picture of what's unfolding. For the fifth consecutive year, the silver market is in a supply deficit. Think about that for a moment. 5 years. That means for 5 straight years, the world has consumed more silver than it has produced. The stockpiles are draining. The vaults are emptying. And yet, most investors are completely oblivious to what this means. The Silver Institute just released their latest data, and the numbers are staggering. Industrial demand for silver now accounts for 59% of total usage. This isn't your grandfather's precious metal anymore. This is the backbone of the green energy revolution. Every solar panel requires silver. Every electric vehicle needs silver. The artificial intelligence boom? It's devouring silver at unprecedented rates. Data centers, 5G infrastructure, medical devices, water purification systems. The list goes on and on. But here's where it gets interesting. While industrial demand is soaring to record levels, mine production is struggling to keep pace. We're not discovering new silver deposits fast enough. The easy silver has already been extracted. What remains requires deeper drilling, more complex extraction processes, and significantly higher costs. Some of the world's largest silver mines are seeing declining ore grades. That means they're pulling up more rock and getting less silver. Now, let me take you back to a moment in history that very few people remember, but everyone should understand. It was early in the previous decade when silver did something that shocked the financial world. The price exploded from around $30 an ounce to nearly $50 in a matter of weeks. Retail investors were scrambling. Coin dealers couldn't keep inventory on their shelves. Premiums skyrocketed. People were waiting months for delivery of physical silver. But here's what most people don't know about that moment. The fundamentals driving that rally were a fraction of what we're seeing today. Back then, industrial demand was strong, but it wasn't critical. Solar panels weren't the massive industry they are now. Electric vehicles were barely a blip on the radar. The green energy transition was just a concept, not a global mandate. Fast forward to today, and the landscape has completely transformed. Governments around the world have committed trillions of dollars to green energy infrastructure. The European Union, the United States, China, India. They're all racing to build out solar capacity, expand EV production, and modernize their electrical grids. And every single one of these initiatives is silver intensive. Let me give you some specific numbers to illustrate the scale of what's happening. A single solar panel requires approximately 20 grams of silver. That might not sound like much until you realize that global solar installations are projected to continue growing exponentially. We're talking about hundreds of millions of panels being manufactured and installed. The silver required for just the solar industry alone is measured in hundreds of millions of ounces annually. Electric vehicles are another massive demand driver. Each EV contains roughly 1 kilogram of silver. That's about 32 ounces per vehicle. Now multiply that by the millions of electric vehicles being produced each year, and you start to see the magnitude of the demand surge. And this is just the beginning. Most major automakers have announced plans to transition their entire fleets to electric by the end of this decade or early next decade. But wait, there's more. The artificial intelligence revolution is creating an entirely new category of silver demand that didn't exist a few years ago. AI data centers require massive amounts of computing power, which means massive amounts of servers, which means massive amounts of silver. Every server, every circuit board, every connection point uses silver because of its superior electrical conductivity. As AI continues to expand, this demand is only going to accelerate. Now, here's where the story takes a fascinating turn. While all of this industrial demand is exploding, something else is happening simultaneously. Investment demand is starting to wake up. For years, silver has been overlooked by institutional investors. It's been the forgotten precious metal, living in gold's shadow. But that's changing. Central banks around the world are diversifying their reserves. They're moving away from dollar-denominated assets and into hard assets. While gold gets most of the attention in this trend, silver is quietly being accumulated as well. The smart money understands that silver offers something unique. It's both a monetary metal and an industrial commodity. It has dual demand drivers that gold simply doesn't possess. Let me tell you about what's happening in the physical market right now, because this is where things get really interesting. The disconnect between paper silver and physical silver is widening. On the COMEX, the futures exchange where silver is traded, There are massive amounts of paper contracts representing silver that doesn't physically exist. It's a fractional reserve system, not unlike banking. For every ounce of physical silver in the vaults, there are multiple claims on that same ounce. This works fine as long as everyone is content to trade paper contracts back and forth. But what happens when people start demanding physical delivery? What happens when industrial users need actual metal, not just a contract promising metal? The system starts to strain, and we're beginning to see signs of that strain. Premiums on physical silver coins and bars have been elevated for months. Delivery times have stretched out. Some dealers are struggling to source inventory. These are all symptoms of a market where physical demand is outstripping readily available supply. And remember, we're still in the early stages of this trend. Now, I want to shift gears for a moment and talk about something that's relevant if you're thinking about your financial future and retirement security. If you have $100,000 or more in retirement accounts, there's a strategy worth understanding. Gold and silver IRAs allow you to hold physical precious metals in a tax-advantaged retirement account. I've put together a comprehensive guide that explains exactly how this works, the rules you need to know, and how to do it without triggering tax penalties. You'll find that in the description below. It's worth checking out if protecting your retirement savings with hard assets is something you're considering. But let's get back to the silver story, because what's about to happen next is where things get truly explosive. We're approaching a critical inflection point. The supply deficit can't continue indefinitely. Eventually, something has to give. Either prices need to rise significantly to incentivize new production and reduce demand, or we're going to see actual shortages in the physical market. Think about what happens when an industrial manufacturer can't get the silver they need to produce solar panels or electric vehicles or medical devices. They don't just shrug and walk away. They pay whatever price is necessary to secure supply. That's how commodity markets work. Price is the mechanism that balances supply and demand, and when supply is constrained and demand is surging, prices have only one direction to go. Here's another angle that most people aren't considering: the gold to silver ratio. Throughout history, this ratio has fluctuated, but it tends to revert to certain levels. Right now, depending on when you're watching this, the ratio has been elevated compared to historical averages. What this means is that silver is undervalued relative to gold. When this ratio normalizes, and it always does eventually, silver tends to outperform gold on a percentage basis. Let me walk you through a scenario. If gold is trading at $2,000 an ounce and silver is at $25, that's a ratio of 80 to 1. Historically, ratios in the 50 to 60 range have been more common during precious metals bull markets. If that ratio were to compress to 60 to 1 with gold at $2,000, silver would need to be at about $33. That's a 32% gain in silver just from ratio normalization, without gold moving at all. But here's the kicker. We're not in a static environment. Gold is also in a bull market, driven by many of the same factors affecting silver: monetary debasement, geopolitical uncertainty, central bank buying, inflation concerns. If gold continues to appreciate while the gold to silver ratio compresses, the mathematics become incredibly favorable for silver. Let's run some numbers. Suppose gold moves to $2,500 an ounce over the next couple of years. Not an outrageous assumption given current trends. And suppose the gold to silver ratio compresses to 60 to 1. That would put silver at over $40 an ounce. From current levels, that's a substantial gain. And if the ratio compresses further to 50 or even 40 to 1, which has happened during previous silver bull markets, you're looking at silver prices in the $50 to $60 range or higher. Now, I know what some of you are thinking. This sounds too good to be true. Markets don't just hand out free money. There must be risks, there must be catches, and you're absolutely right to think critically. Let me address some of the counter-arguments and risks. First, industrial demand could weaken if we enter a global recession. That's a legitimate concern. However, the green energy transition is being driven by government mandates and subsidies, not just market forces. Even during economic downturns, these infrastructure projects tend to continue because they're viewed as strategic priorities. Additionally, the supply deficit means that even if demand softens slightly, we're still consuming more silver than we're producing. Second, new mining production could come online and flood the market. This is theoretically possible, but practically difficult. It takes years to bring a new mine from discovery to production. We're talking about 5 to 10 years in many cases. The silver that would be needed to address today's deficit would have needed to be discovered and developed years ago. The pipeline simply isn't there. Third, recycling could increase and add to supply. Silver is indeed recyclable, and higher prices would incentivize more recycling. However, much of the silver used in industrial applications is consumed in tiny quantities spread across millions of products. It's not economically viable to recover silver from a single solar panel or circuit board. The recycling that does occur is already factored into supply calculations, and it's not enough to close the deficit. Fourth, technological substitution could reduce silver demand. Some applications might find alternatives to silver, but here's the reality. Silver is used precisely because it has unique properties that are difficult or impossible to replicate. It's the most conductive metal, the most reflective metal, and it has antimicrobial properties. Engineers don't use silver because they want to, they use it because they have to. Finding substitutes that perform as well is extremely challenging. Let me tell you about what's happening in China right now, because this is a crucial piece of the puzzle that many Western investors are missing. China is the world's largest producer of solar panels. They're also the world's largest installer of solar capacity, and they're aggressively stockpiling silver. Chinese imports of silver have been surging. They understand the strategic importance of this metal for their industrial ambitions. But China isn't just buying silver for immediate use. They're building reserves. They're securing supply chains. They're thinking decades ahead. And when a nation of over 1 billion people with the world's second largest economy decides that a particular commodity is strategically critical, that has profound implications for global markets. India is another major player in the silver market, though for different reasons. India has a cultural affinity for precious metals. Silver jewelry, silver coins, silver utensils. It's deeply embedded in the culture. Indian demand for physical silver is substantial and relatively price inelastic. When prices rise, Indians don't stop buying silver. They might slow down temporarily, but the cultural demand persists. Now let's talk about the investment landscape and what sophisticated investors are doing. Exchange-traded funds that hold physical silver have seen significant inflows recently. These aren't retail investors buying a few ounces. These are institutional allocations, pension funds, family offices. The smart money is positioning for what's coming. But here's something interesting about silver ETFs. When you buy shares in a silver ETF, the fund is supposed to buy physical silver to back those shares. That silver gets stored in vaults, taken off the market. As more money flows into these ETFs, more physical silver gets locked away, reducing the available supply for industrial users. It's a self-reinforcing cycle. Investment demand removes metal from the market, tightening supply, which drives prices higher, which attracts more investment demand. There's also a growing movement of retail investors who are buying physical silver and taking delivery. They're not interested in paper claims or ETF shares. They want the actual metal in their possession. This trend, sometimes called the silver squeeze, has been building momentum. While it's had mixed results in terms of immediate price impact, it's contributing to the overall tightness in the physical market. Let me share a perspective that might seem controversial but is worth considering. Some analysts believe that silver is one of the most manipulated markets in the world. They point to the concentration of short positions on the COMEX, the repeated price smashes that seem to occur at convenient times, and the disconnect between paper prices and physical premiums. Whether you believe in market manipulation or not, what's undeniable is that the physical market is tightening while paper markets show abundant supply. That divergence can't persist forever. Here's a thought experiment. Imagine you're an industrial manufacturer who needs silver to produce your products. You have contracts to fulfill, customers waiting, employees to pay. You go to secure your silver supply, and you're told there's a 6-month wait for delivery. Or the premium over spot price has doubled. Or your usual supplier can't guarantee availability. What do? You panic buy. You lock in supply at whatever price is necessary. You might even buy more than you immediately need just to ensure you're covered. Now multiply that scenario across hundreds or thousands of industrial users worldwide, all competing for a finite supply of physical metal. That's how shortages cascade into price spikes. It's not a gradual, orderly process, it's sudden and dramatic, and once it starts, it feeds on itself. Let's talk about the mining industry for a moment, because understanding the supply side is crucial. Silver mining is unique in that most silver isn't produced from primary silver mines. It's a byproduct of mining other metals, particularly copper, lead, and zinc. This means that silver production is largely dependent on the economics of these other metals. If copper prices are low, copper mines might reduce production or shut down, which also reduces silver output as a byproduct. This creates an interesting dynamic. Even if silver prices rise significantly, It doesn't immediately translate into more silver production because the mining decisions are being driven by the primary metal, not the byproduct. It takes time for higher silver prices to incentivize new primary silver mine development, and as I mentioned earlier, that process takes years. There's also the issue of declining ore grades. Many of the world's major silver deposits are getting harder to mine. The easy, high-grade ore has been extracted. What remains requires more energy, more processing, and more cost to extract the same amount of silver. This means that even if mining companies want to increase production, they're fighting against geological realities. Let me paint a picture of what a silver bull market could look like based on historical precedents. In the late 70s and early 80s, silver went from around $5 an ounce to $50 in a relatively short period. That's a tenfold increase. Now, I'm not predicting a tenfold increase from current levels, but I want you to understand the magnitude of moves that are possible in this market. What drove that previous bull market? A combination of factors: inflation concerns, geopolitical instability, and yes, some speculative excess. But the fundamental driver was a belief that precious metals were a store of value in uncertain times. Fast forward to today, and we have all of those same factors, plus the massive industrial demand that didn't exist back then. Here's what makes this setup so compelling. We have the traditional precious metals bull market drivers: monetary expansion, currency debasement, geopolitical tensions, inflation. But we also have this entirely new dimension of structural industrial demand that's not going away. Even if investment demand wanes, industrial demand continues. It's a floor under the market that didn't exist in previous cycles. Think about the implications of that. In past precious metals bear markets, prices could fall dramatically because demand was primarily investment-driven. When sentiment turned negative, there was no underlying support. But now, with industrial demand consuming the majority of supply, there's a natural floor. Industrial users need silver regardless of investor sentiment. They'll pay what they must to secure supply. Let's consider the macroeconomic backdrop, because that's providing a powerful tailwind for precious metals broadly. Central banks around the world have expanded their balance sheets to unprecedented levels. The money supply has exploded. Government debt has reached levels that would have been unthinkable a generation ago. And there's no realistic path to fiscal responsibility on the horizon. What does this mean for currency values? It means debasement. It means that the purchasing power of fiat currencies is being eroded. And when people lose faith in paper money, they turn to hard assets. Gold and silver have been money for thousands of years. They can't be printed, they can't be created out of thin air, and they have intrinsic value. Now here's where silver has an advantage over gold. Silver is more affordable for the average person. If gold is trading at $2,000 an ounce and silver is at $25, which one is more accessible to someone who wants to start building a position in precious metals? Silver's lower price point makes it the people's metal. It's the way that ordinary individuals can participate in the precious metals market without needing substantial capital. This accessibility factor shouldn't be underestimated. When precious metals bull markets really get going, retail participation can be enormous. People who would never consider buying gold at $2,000 an ounce might buy silver at $30 or $40. That retail demand can add significant buying pressure to an already tight market. Let me share another historical parallel that's instructive. In the early part of the last decade, there was a moment when silver briefly traded above $48 an ounce. The rally was driven by a combination of investment demand and concerns about the financial system following the crisis of the previous years. But here's what's different about today's setup. That rally occurred when there was still adequate supply. The market wasn't in a structural deficit. Today, we're in year 5 of consecutive deficits, and the deficit is widening, not narrowing. What happens when you combine a structural supply deficit with a surge in investment demand? You get a price explosion. It's not a matter of if, it's a matter of when. The fundamentals are so compelling that it's difficult to construct a bearish case for silver over the medium to long term. Now let's talk about timing, because that's what everyone wants to know. When is this going to happen? The honest answer is that nobody knows with precision. Markets can remain irrational longer than you can remain solvent, as the saying goes. But we can look at indicators and catalysts that might trigger the next major move. One catalyst could be a shortage in the physical market that becomes impossible to ignore. If major industrial users start publicly acknowledging supply difficulties, that could spark a rush to secure inventory. Another catalyst could be a currency crisis or a loss of confidence in the dollar. If the dollar weakens significantly, precious metals typically rally as they're priced in dollars globally. A third potential catalyst is a major geopolitical event: war, trade conflicts, financial system stress. These types of events drive safe haven demand for precious metals. And given the current state of global affairs, it's not difficult to imagine scenarios that could trigger such demand. But here's what I think is the most likely catalyst: a gradual awakening to the supply-demand fundamentals. As more investors, analysts, and institutions study the silver market and recognize the deficit, the structural demand, and the limited supply response, capital will flow into the sector. This doesn't require a crisis or a dramatic event. It just requires people to do the math and recognize the opportunity. Let me address a question that often comes up. What about a recession? Won't that kill industrial demand and tank silver prices? It's a fair concern, but consider this. The green energy transition is being driven by government policy, not just economic growth. Solar installations, EV production, grid modernization. These are strategic priorities that continue even during economic downturns. In fact, governments often accelerate infrastructure spending during recessions as a form of economic stimulus. Moreover, if we do enter a recession, central banks will respond with more monetary stimulus. More money printing, lower interest rates, more quantitative easing. And that's bullish for precious metals as a hedge against currency debasement. So even in a recessionary scenario, silver has support from both continued industrial demand and increased investment demand. Here's another angle to consider. The energy transition is creating entirely new categories of silver demand that didn't exist before. Energy storage systems, smart grid technology, advanced electronics for autonomous vehicles. These are growth industries that are just getting started. The silver intensity of the global economy is increasing, not decreasing. Think about what that means over the next decade. As these technologies scale up and become ubiquitous, the amount of silver required annually will dwarf current consumption levels. And remember, we're already in a deficit with current demand levels. How much worse will that deficit become as these new demand sources ramp up? The mathematics of the situation are stark. If annual demand increases by even 10 or 20% over the next few years and supply remains constrained, the deficit widens dramatically. The only way to balance the market is through significantly higher prices that either incentivize new supply or ration demand. There's no other mechanism. Let me paint a picture of what the silver market could look like in a few years if these trends continue. Imagine silver trading at $75 or $100 an ounce. At those prices, marginal mines become economic. Recycling becomes more attractive. Some industrial users might find ways to reduce consumption or find substitutes. But getting to those prices requires a massive repricing from current levels. And here's the thing about commodity bull markets. They tend to overshoot. They don't just rise to the level where supply and demand balance. They go beyond that as speculation and momentum take over. We saw this in the previous silver bull market. We've seen it in oil, copper, and virtually every other commodity. Human psychology drives markets to extremes in both directions. So when I say silver could do the impossible, what I mean is this. Silver could deliver returns that seem impossible based on conventional thinking. It could move from being an overlooked industrial metal to being recognized as one of the most critical commodities of the energy transition. It could go from being gold's forgotten little brother to being the star performer in the precious metals complex. The setup is there. The fundamentals are there. The supply deficit is real. The industrial demand is accelerating. The investment demand is starting to awaken. All the pieces are in place for a historic bull market in silver. Now, I'm not suggesting that everyone should rush out and put their entire net worth into silver. That would be reckless. But I am suggesting that silver deserves serious consideration as part of a diversified portfolio, particularly for those who understand the fundamentals and have a medium to long-term time horizon. The risk-reward proposition is compelling. The downside is limited by industrial demand and production costs. The upside is substantial if the supply-demand dynamics play out as the fundamentals suggest. And the catalysts for a major move are numerous and growing more likely by the day. Here's my final thought on this. We're living through a unique moment in history. The convergence of the green energy transition, monetary debasement, geopolitical instability, and a structural supply deficit in silver is creating an opportunity that may not come around again in our lifetimes. The question isn't whether silver will have its moment. The question is whether you'll be positioned to benefit when it does. The impossible is about to become possible. The forgotten metal is about to be remembered. And those who recognize this shift early will be rewarded for their foresight. The silver moonshot isn't just coming. It's already begun. The only question is whether you're on board for the ride.